when you take a house on rent, generally you give some money as deposit, 3 months rent or 4 months rent or 6 months rent as deposit. Why do we give this deposit? When you leave this house, if you've done something, the owner keeps some money. If he has to repair the house once you leave it, he will take it out of that deposit. This deposit is nothing but collateral. So collateral is not a new term. It is used across banking. In stock market, collateral is also a term. When you give some margin to buy shares, it is known as collateral.
This time around, we have again Ashish Nanda, the head of digital business at Kotak Securities, to demystify another trending word called collateral. We are looking forward to asking you some tough questions on a new concept called collateral or collateral as margin. What is this collateral? Hello everyone. Thanks a lot for all the love and support that we've got for our last podcast on Pay Later. This time around, we have again Ashish Nanda, the head of digital business at Kotak Securities, to demystify another trending word called collateral. Hi Ashish.
Hi.
We are looking forward to asking you some tough questions on a new concept called collateral or collateral as margin. What is this collateral?
Thanks, Maulik. See, collateral is not a new term. Knowingly or unknowingly, we use collateral at many times in our life. Just to give you an example, I think when you take a house on rent, generally you give some money as deposit, 3 months rent or 4 months rent or 6 months rent as deposit. Why do we give this deposit? When you leave this house, if you've done something, the owner keeps some money that if he has to repair the house once you leave it, he will take it out of that deposit. This deposit is nothing but collateral. So while we may call it a deposit, it is something, it works in the same way as a collateral. Same way if you buy a house and you take a loan from the bank will generally keep your papers as a collateral. Okay, just in case खुदा ना खास्ता ऐसा ना हो, but अगर आप लोन नहीं पे कर पाए, bank can repossess that house and safeguard his loan. Car liya aapne, car is taken as a hypothecation by the bank. So this is all collaterals that the banks take. So collateral is not a new term. It is being used in banking for many years. In stock market as well, while हमें सबको पता है कि if you want to buy a share, you have to pay full money and buy share. 1 lakh का share खरीदना है, you pay 1 lakh rupees and buy 1 lakh of shares. But there is something called collateral. You can also give collateral in some other form, not just cash, and buy shares as well. So collateral is not a new term. It is used across banking, and in stock market, collateral is also a term. When you give some margin to buy shares, it is known as collateral.
Got it, Ashish. So are there any forms of collateral? Because there's something called as cash collateral, non-cash collateral, cash. So how do we as end users understand the difference between all these three?
See, Maulik, in our normal walk of life, whenever you're going to buy anything, you have to pay money in cash. If you go to buy groceries, you have to pay money in cash. If you want to buy clothes, whatever you want to buy, you have to pay money in cash. Same way, everybody thinks that even in stock market, when you're going to buy stocks, you have to pay cash and buy stocks. Normal hai. I think this is how most of the people, when they are investing in stock markets, they will generally pay money in cash and buy stocks. However, collateral is something which can also help you make a little bit higher return on your money that you're investing in stock market. There are technically two forms of collateral. One is a cash collateral and one is a non-cash collateral. मैं दोनों को explain करता हूँ. When you give cash, technically it is considered as cash collateral. So cash is one form of cash collateral. But however, if you give very liquid assets which can be sold at any point of time and converted into cash, they are also considered as cash collateral. Examples like, I'll give examples like ETF. If you're buying liquid ETFs, Nifty Bs hai, Kotak One karke, there is another liquid B. So all these are liquid funds which are also considered as cash collateral. Liquid mutual funds, sovereign gold bonds, treasury bills, these are all forms of cash collateral. On the other side, Non-cash collateral are assets which are not that liquid, which are in other forms. All stocks, when you buy in shares, are considered as non-cash collateral. So are all mutual funds other than liquid mutual funds. All ETF other than liquid ETFs. We also allow at times REITs as collateral. So all these are considered as non-cash collateral, while cash and other forms of liquid cash investments are considered as cash collateral.
So now that we know there are three ways to give margin for your either derivative positions or MTF, uh, why should someone or when should someone use what margin, and why is it beneficial for the user, or is it even beneficial for the user to use collateral as margin?
No, of course, Maulik, it is very beneficial. I tell you, क्या होता है कि simple normal terms में when you can buy stocks by paying cash. 1 लाख का स्टॉक खरीदना है, 1 लाख रुपए आपके पास है, आपने 1 लाख दिया और आपने स्टॉक ले लिया. At times, what happens is you get a very good opportunity. You think I want to buy this stock. However, you do not have cash. What do? That is where collateral comes to your rescue. So what you have to do is, if you have some other stock, for example, example के तौर आपके पास share A है and you want to buy share B, you can pledge this share A as collateral with the broker and you can then buy a stock B. You need not pay it in cash. But इसके अंदर भी कुछ parallels हैं जिसकी बात करेंगे. Whatever you want to do in stock market, whether you want to trade in cash, which is you want to buy stocks, you want to buy stocks for intraday trading, you want to buy stocks for long term under MTF, हमने margin funding की पिछले वीडियो में बात की थी, or if you want to buy future and options, you want to trade in derivatives, you want to trade in commodities जहाँ पे margin देना पड़ता है, at all these places you can use collateral instead of paying real cash as margin. So collateral comes to your rescue when you do not have cash and you want to trade in markets right now. You have an opportunity. You can give other forms of collateral as margin and trade in the market. This is one. Liquidity nahi hai, then collateral comes to your rescue. Second is also there are a lot of traders who make use of money very systematically. Better use of money. Any small return they want to take use of that return. So क्या होता है कभी-कभी when you give cash as margin and they do trading in FNO, or you want to do intraday trading, cash doesn't earn you anything. Broker will take the cash, that is as margin. However, if this cash can also earn you something while it is being treated as margin, I think it gives you that little higher return. So I think a lot of people, what you can do is, instead of giving cash to the broker, you can park that in liquid ETFs. And once you park that in liquid ETFs, you can hypothecate or give that liquid to the broker as margin for the purpose of trading in stocks. So this will also earn you a 6-7% liquid rate of return. You can also park it in stocks. You think यार ये stock अच्छा है, मैं stock खरीद लेता हूँ. Give that stock as margin towards buying some other stock. So I'm saying efficient use of money also comes. So one is liquidity. Second is best use of money. These two concepts, I think, is why you should use collateral while trading in stocks.
So got it. Basically, we are saying that especially traders, if they have to optimize their returns, there's a good case for them to use collateral as margin.
Yeah, optimize will be the better word. I was not getting that word. Yeah, if you want to optimize your returns, of course, instead of giving cash, if you can give collateral, I think you will get a better return out of your overall capital.
Got it. But for example, if a derivative trader wishes to use this, there is a concept of 50-50 margin, or 50% cash and 50% non-cash margin that is mandated by the regulators. Can this collateral be used, and how can derivative traders optimize their returns, as we are saying, by using the collateral margin in 50-50?
So Maulik, let's just break it up into three parts. One is using collateral while buying stocks. Second is using collateral for buying FNO derivatives. And third is using again collateral to buy in commodities. तीन part में break करते हैं. पहले let's start with cash. I think cash market investors are the highest in the market. So let's first talk about cash. Cash also I will again divide it into three parts. One is using cash for purely buying stocks and keeping it with you. Second is using this collateral for doing intraday trading. And third is using this collateral for trading in margin funding, keeping stock for long term. In all these three cases, Maulik, we can use collateral as margin. So when you're buying stocks, the way that people know is generally you pay cash and buy stocks. तुमने Monday को stock खरीदना है, you gave 1 lakh rupees to the broker and you bought 1 lakh of stock. However, the broker has to pay to the exchange only on next day. So a lot of places, brokers also allow you to only give collateral and buy stocks and pay the full amount on the next day. One day, you can delay the payment by 1 day. So I'm saying this is how you can use collateral for buying stock. Instead of paying full 1 lakh rupees, you only pay margin, 20%, 25%, as the case may be, जो भी stock के लिए चाहिए, and pay the full amount on T+2. At Kotak, we call this order type NRML. So if you, instead of, एक हमारा CNC है, which is cash and carry, pay cash and buy. Second is NRML, where you pay as collateral on Monday, but you have to pay the entire amount the next day. So this is where you use collateral for buying cash. Second is intraday trading. There is an order type called MIS, which is only for intraday trading. All stocks get squared off at 320, 325, as the case may be. Here also you can give collateral. Since you are buying and selling the same day, you need not pay cash and you can do intraday trading. You also get the benefit of leverage. So for example, you've got 1 lakh rupees of stock as collateral. Haircut लगता है उसके ऊपर. Suppose the value becomes 80,000. 20% haircut लेते हैं just for normal understanding. This 80,000 you can leverage 1x, 2x, 3x as the case may be, depending upon the stock that you want to buy, and that collateral can be used for buying in. So stock A, 80,000 rupees, you can buy 4x of stock B for intraday trading. You can buy 3,20,000 of stock B, but this is only for intraday. The third way is MTF. You want to buy a stock, you like it, you want to keep it for long term. We discussed in the last video. Again, you can give collateral as margin and buy a stock under MTF. So this is how you trade in equity markets.
Let me stop you here. We can go to derivatives.
Sure.
Because you've again brought a very important concept called haircut.
Yes.
In collateral. What exactly is haircut?
So haircut पे पहले बात करते हैं मौलिक. See, what happens is depending upon the stock or collateral that you have given, some assets are liquid, some are illiquid. In stocks also, there are large caps, there are mid caps, there are small caps. Even in mutual funds, there are various kind of mutual fund schemes. There are large cap schemes, there are thematic schemes. And depending upon whatever you are buying, the risk of every stock or mutual fund is different. A small cap will be high risk, a large cap will be low risk. A large cap stock will be having lesser risk, a small cap will have a larger risk. So depending upon the quality of stock that you give as collateral, there are different haircuts associated with each asset class. For example, liquid Bs. Liquid Bs, when you invest into, liquid Bs are very liquid assets. You can just go and sell at any point of time, they will sell in the market. So here the haircut is the least. For example, we charge 6% haircut in liquid Bs. So if you give 100 rupees of collateral, you are able to use 94 rupees of that money for doing trading either in derivatives or in cash. But if you give a stock which is large cap, we have a haircut between 13 to 15%. If you go to mid caps, the haircut will be 20 to 25%. If you go to small caps, the haircut will be even more, 35%. Haircut goes all the way till 50%. So haircut can be anywhere between 6 and 50%, but depending upon the liquidity of the asset, what quality of the asset, haircuts are defined.
Also, are the haircuts defined by the broker or they are defined by exchanges or regulators or clearing corporation?
So there is a haircut which is defined by the exchange or the clearing corporation, as we call. They have a haircut. So every stock has a defined haircut depending upon, again, the quality and liquidity of the stock. Brokers also can have a higher haircut than what is stipulated by the exchange. So I think exchange stipulates a 15% haircut. Depending upon their own risk management, brokers sometimes have a 17, 18, 20% haircut as well. But yeah, there is a haircut which is defined by the exchange, and brokers have a prerogative of a higher haircut, not lower haircut. So at Kotak, I think much of what we do is at what exchange stipulated margins. But yeah, we may be charging higher haircuts than what is being stipulated depending upon our risk management policy.
We can go back to the derivatives.
Yeah. So as I was telling you how collateral is used in equities, same way in derivatives and in F&O, it is again an asset class where you have to pay margin. This margin can be in the form of cash, and a lot of people we know pay cash to even trade in derivatives in F&O and in commodities. Here also you can give derivative as margin. So you can give stock as margin or mutual fund as margin. So again, this comes to your rescue at the time of trading in F&O as well. You can give same collateral for F&O trading in the form of cash or non-cash collateral.
And what exactly is that 50% regulation that is there, especially for derivative trade?
Yes. So what happens is, so I think this has to also be seen in a way of how interest is charged on the collateral.
Okay.
So पहले cash पे आते हैं. In cash, what you have to understand is interest is not charged on collateral. When you give collateral as margin, against that you buy shares. If you do anything intraday, then there is no interest incidence at the end of the day. आपने 1 लाख रुपए का स्टॉक खरीदा, 1 लाख रुपए का स्टॉक इंट्राडे बेच दिया. At the end of the day, there is no debit balance, so there is no interest charged. If you go into margin funding where you bought something for long term, again there is a buy value. You buy 1 lakh rupees of stock, the interest will be charged on the value that you buy. You are never charged interest on collateral. This is for cash market. However, in derivative and commodities, F&O and in commodities, it is little different. Here, interest is charged on the collateral that you give for the purpose of buying future and options or commodities. What happens is, एक example लेते हैं. Suppose there is a contract that you buy. One nifty contract लेते हैं. Value about 17 to 18 lakhs. The margin required, say, on this contract is about 2 lakh rupees. This 2 lakh you have to give in the form of, you can give in the form of cash, you can give in the form of collateral. What the exchange stipulates is that 50% of this collateral has to be in the form of cash and 50% of this collateral has to be in the form of non-cash. So when I say cash, it is cash collateral. When I say non-cash, it is non-cash collateral. This is the arrangement between the broker and the exchange, clearing corporation. So when the broker pays collateral to the exchange, it has to be in the form of 50% cash collateral, 50% non-cash collateral. There is no such stipulation between the customer and the broker. The customer can pay 100% as cash collateral or 100% as non-cash collateral. Just to say this 2 lakh rupees of margin required for one contract can be in the form of any stock. You can put stock A worth 2,50,000 rupees. After haircut, it becomes 2 lakh rupees. This 2 lakhs can be given as margin and the broker will allow you to trade in derivatives. Same way, you can give anything in the form of cash collateral, which can be liquid funds or anything. Again, broker will allow you to trade. So between broker and clients, there is no stipulation. The issue comes in the form of interest. If you give cash collateral 100%, then there is no problem at all. You can give 100% liquid fund, 100% cash. The broker will give this collateral to the exchange and there is no incidence of interest. So long as the client gives 50% cash and 50%, at least 50% cash and stock, then also there is no stipulation of interest, because broker को भी आगे exchange को 50% stock and 50% cash collateral ही देना है. The problem comes when the customer has given less than 50% as cash collateral. So just to say, a customer gives 30% of his money, 1 lakh रुपए में से 30%, which is 30,000 rupees, client gives as cash collateral in the form of, say, liquid ETFs, and 70,000 he gives in the form of stock. Here is where the incidence of interest comes, because as broker will have to give cash collateral to the exchange to the extent of 50%. 30% client has given. The balance 20% broker will have to fund it out of his pocket. So when he funds this 20% out of this pocket, he will have to either borrow and then give it to the exchange. So there is an incidence of interest. That is what is charged to the customer. At Kotak, we charge a rate of interest of 9% on this 20,000. So long as you have 50% cash collateral, no interest. Anything short of 50% is on which, that is the amount on which interest will be charged. At Kotak, all our trade-free plans, trade-free youth and trade-free pro, we charge a rate of interest on this margin which is equivalent to 9%.
And as you mentioned that if the user does intraday trading in cash segment using collateral, there is no incidence of interest. Does the same apply to derivatives as well?
So 2-3 misconceptions मैं clear करता हूँ. पहला, intraday पे at Kotak we do not charge any interest. If you buy today, you sell today, you give 100% of margin as non-cash collateral, still no interest will be charged.
Even in the derivative segment?
In derivative, in commodities, in cash, no interest is charged so long as the trades are intraday. Only if you have an end of day balance. So if you take a derivative position which you carry forward to the next day, and the interest, say the margin requirement is 2 lakh rupees, at least 1 lakh rupees has to be in the form of cash collateral. If there is any shortage from that 1 lakh rupees, you have paid 50 instead of 1 lakh, on the balance 50 which you have not paid in the form of cash collateral, interest will be charged. But intraday there is no concept, no interest incidence. The second misconception is people think जितना collateral दिया उसके ऊपर interest लगेगा, whether used or not. So again, interest is not charged on collateral. Interest is charged basis usage. आपका 10 लाख का collateral पड़ा है broker के पास, लेकिन आपने उस 10 लाख में से use सिर्फ 1 लाख ही किया है, then you will be charged interest only on that 50,000 cash collateral which you have not paid, which is 50% of the utilized margin. So it is not on collateral, it is on the utilized collateral. So I think there are two misconceptions which I thought people ask me many times, how does interest on collateral work? So I thought maybe I will explain this.
Absolutely,
as well.
I'm pretty sure that is of much use to our users. Also recently, Ashish, if I'm not wrong, couple of months back, Clearing Corporation had come out with a change in the number of stocks that can be used as collateral. So today, say we have more than 2,000-3,000 stocks that are available. Can all the stocks be utilized as collateral?
So iske andar bhi there are two things that I think people, all investors and traders need to understand. The first thing is that again, this arrangement of stocks which is stipulated by the clearing corporation is between the broker and the clearing corporation. The broker can have a different arrangement with the client. So at Kotak, for example, we allow all the stocks which are allowed by the clearing corporation. Apart from that, we have some 100 to 150 extra stocks which we think that we are okay with respect to our risk management policy, and we can accept these stocks as margin. So we have broadly a list of somewhere between 900 to 950 stocks which we allow as margin. The second thing, Maulik, is the number of stocks available. I said 900 stocks are available in case of stocks. We allow about 5,800 mutual funds which can also be pledged as margin. We also allow about 186 ETFs. We allow all sovereign gold bonds. We allow all government securities as margin. So it's a very vast list. We also allow REITs as margin. REITs and InvITs are generally not allowable as margin at most of the places, but we even allow REITs and InvITs as margin. So it's a fairly large list of stocks which is available and which can be pledged as collateral.
And only pay later or MTF as a product cannot be used with some portion of the collateral, right? So if you can help us.
Yes. The only one thing I think we explained in the last video as well, mutual fund is the only thing which cannot be used as collateral for the purpose of buying MTF stocks. So this is the only one exception that we have. Otherwise, everywhere mutual fund, stocks, any other form of collateral is used. The only exception is mutual fund, which is not allowed here. The second thing also is all these securities have to be in demat form. If you have the mutual funds in physical form, or if you have got stock certificates, they cannot be used as margin. For the purpose of use of margin, all these have to be in the form of demat shares. So this is only one thing that people have to be very sure of. It has to be demat securities, and mutual funds cannot be used as margin for the purpose of MTF trading.
Absolutely. One more point, Ashish. So we are comparing how illiquidity as a problem can be solved using collateral. So if I have stocks in my portfolio or mutual funds or liquid ETFs in my portfolio, and if I intend to, get collateral margin against them, how quickly do I get it?
So what happens is, if you have got demat securities already lying and they are allowed as margin by the broker, I think you have to just go to the pledge section. So for example, at our end, under the fund sections, you can go and pledge those securities. You have to choose your stocks, whichever you want to pledge. Post that, the site will itself take you into the NSDL site, where you have to put your PAN number, do an OTP, and the shares get pledged. At our end, we give margin for now in about 7 to 8 minutes. But I think soon we are working on instant margin, and I think over a month's time we should have a process where the margin will be allowed instantly. But as of now, it takes about 8 to 10 minutes. If you pledge about 8 to 10 minutes, you will get margin. Same way, you can also unpledge these stocks as well. The good part is that you don't have to unpledge. Suppose you have given a stock as margin, and you certainly decide that ये stock मेरे को बेचना है. The good part at our end is that you don't have to unpledge these stocks to sell these stocks. So if you just sell the stocks which are already pledged to Kotak, we will unpledge it and we will deliver the stocks to the exchange. So you don't have to unpledge it. Slightly different in mutual funds. In mutual funds, the money goes directly from the fund house to the customer. In case of mutual funds, if you do sell them, you will have to first unpledge it and then sell. So stocks, no unpledging, you can just go and sell. In mutual funds, you will have to unpledge and then sell.
Got it. Ashish, one more question we've been getting from a lot of MTF or pay later users is pay later positions, or the stocks that user purchases using pay later or under pay later. Can they be used as collateral? Because they also now get auto pledged.
So I get this question again, Maulik, quite a lot, where people say, if I buy a stock under MTF, can I then pledge those stocks and trade in derivatives? People want to do that. Unfortunately, since stocks bought in MTF are not fully paid stocks, you have only paid part of those stocks in the form of margin, 33%, 40%, and 60% is funded by the broker. They are not fully paid stocks, and so long as they are not fully paid stocks, you cannot pledge them for the purpose of using as a margin. So stocks bought in MTF, since they are not fully paid, they cannot be used as margin for the purpose of derivative trading.
Got it. One more question we have is, when user pledges and gets collateral margin, can I use the same collateral margin over and over again during the day, or is it just that I can use it once and then I'll be able to use it only next day?
मौलिक एग्जांपल लेते हैं अगेन. आपने मुझे 10 लाख रुपए का स्टॉक दिया, and post haircut of 20%, we are taking an example, this becomes 8 lakh rupees of stock which is available as collateral. So during the day, you can take any position up to 8 lakhs. So what you can do is, you can buy a stock, you can take derivative position, so long as the margin required in those derivative positions is up to 8 lakh rupees. If you square off some positions and the derivative requirement becomes lesser, it becomes say 4 lakhs, you again have balance 4 lakh available to take fresh positions. But you can at no point of time exceed the 8 lakh limit that you have, which is the value of stocks available after haircut. And again, you have to understand, this 8 lakh will keep moving. Depending on the price in the market, it may become 790, it can become 810. And we mark to market the collateral with live prices. But so long as you trade within this 8 lakh or 8 lakh 10,000 limit, there is no problem. You can reduce, you can again increase, but you cannot cross this 8 lakhs.
Now that is bringing me up to another question, and usually, Ashish, you have those words of wisdom. So here, with collateral, what are the risks associated, right? When user uses collateral as margin, and say on a bad day, even the position that the user has taken goes down, as well as the stock that has been pledged goes down. What is the worst case scenario that the user looks at?
So Maulik, the risk is same in stock market, which is the risk of buying stocks. Suppose आपने stock लिया, stock का value नीचे गिर गया. I'm saying there is a risk of erosion of value. But in stock market, how collateral works is, example लेते हैं, easy होगा understand करना. You have given 2 lakh rupees as collateral post haircut, and you've taken a position which requires 2 lakh rupees of margin. What the investor or trader has to understand is at all points of time, the margin should be available in the account. So say your position is 10 lakhs, you've given 2 lakh rupees of margin, but the value of this position comes down. So there is mark to market. This mark to market will have to be replenished by the customer immediately. Otherwise, the broker has the prerogative to square off the position. So again, whatever collateral you have given, the collateral you will have to make sure is always sufficient for the position that you have taken. If you do not have sufficient collateral, broker has the prerogative to square off the position. So what I always suggest customers is, when you give collateral, keep some buffer in the form of collateral, either collateral or in the form of cash, so that if there are volatility in the market and there are some mark to markets available, there is enough margin available to take care of those mark to markets.
So I'm just rephrasing what you've just answered. So in no circumstances, if the user maintains the sufficient margin required for that position, the stocks that are pledged will never be touched.
Absolutely.
Right? The fear that users usually have is, I don't want to pledge because there could be a scenario where you will square off not just my position, but also liquidate my stocks.
So I'm thinking absolutely right, Maulik. So long as you maintain enough margins, broker will not touch your collateral positions at all. We have seen a lot of our clients have very large collaterals pledged with us, but they use a very small portion of that while taking positions. And even if there is volatility in the market, they have sufficient buffers available. For those clients, there is nothing. This is their stock, this is their positions, and they will have to take their call whenever they want. Broker can only touch their collateral if there is a shortage of margin. So long as there is enough margin available, broker will not touch their positions.
Got it, Ashish. Ashish, the most important question now is, what are the charges associated with pledging?
Yes. So Maulik, whenever you pledge, the charges are 20 rupees per pledge. 20 rupees plus GST for
Per
every
ISIN.
per ISIN. So suppose you are pledging two stocks, stock A and stock B. You pledge say 5 lakh rupees of stock A and 5 lakh rupees of stock B. Whenever you pledge, you will be charged 20 rupees for pledging stock A and 20 rupees for pledging stock B. So it is 40 rupees. And whenever you unpledge, there is again a charge of 20 rupees to unpledge. So again, this stock you've pledged, the charges are 40 rupees. Whenever you unpledge or you sell the stock, we will unpledge it and then deliver. There will be again a charge of 20 rupees on unpledging. So 20 plus 20 on buying, 20 plus 20 on selling. This is how broadly the charges work. The one thing that you have to also understand is, in selling, investors have to be careful. If you sell a stock, currently we unpledge and deliver to the exchange immediately, so that we have to give customer margin for the purpose of buying something else. A lot of clients who say कि मैंने बेच दिया, अभी मेरे पास कैश आ गया, मुझे कुछ और खरीदना है. So suppose you sell 5 lakh rupees of stock and it keeps selling, and you put a limit order. I want to sell these stocks at 100 rupees. And this doesn't sell in one go. It sells in slowly. Something sells at 10 o'clock, something sells at 12 o'clock, something sells at 2 o'clock. You can also put 3 limit orders. I want to sell at 99, 100, 101. This goes in 3 slots. So whenever you sell it, we'll be unpledging that much of quantity and delivering to the exchange. So it is so possible this 5 lakh rupees that you've sold during the day may go in 3 tranches. We will unpledge it 3 times. So unpledged charges will be charged 3 times, 20, 20, 20. So that is what an investor has to be careful. If he has sufficient margin, he can opt for unpledging and then he can sell. That is one way of doing it. But if he sells not in one go but in tranches, there is a possibility that he will have to pay unpledged charges 3 times. But at the time of pledging, it is only 20, 20. At the time of selling, I think there can be chances that he has to pay unpledged charges multiple times.
Thank you, Ashish. Thanks a lot. I'm sure we've answered a lot of questions on collateral as margin, and it has been our endeavor to try and demystify such subjects. Last time it was pay later, this time collateral. Thanks a lot, Ashish, for answering all the questions.
Thanks, Maulik. I think this is our second video, and we plan to do many more such videos in the times to come. So don't forget to subscribe to this channel,
And like and comment.
of course, and like and share this video as well. Thank you, everyone.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.